Hey everyone, this is Chris. Welcome back to the channel. So, Federal Chair Jerome Powell just gave a speech that's essentially tanking the markets. We're going to take a look at the full speech together, and I'll share some thoughts. And well, let's get into it. So, here's a speech right here. You can see they gave it at, he gave it at 10 a.m. Eastern Time. So, August 26, 2022. And let's take a look at this thing. Thank you for the opportunity to speak here today. At past Jackson Hole conferences, I've discussed broad topics as the ever-changing structure of the economy and challenges of conducting monetary policy with high uncertainty. Today, my remarks will be shorter, focus narrower, and my message more direct. So, looks like he's going more hardcore here, message more direct, and get straight to the point, right? The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal. So you guys, on the channel, we've been talking about this for a long time. Inflation's running really, really hot. It's like, been 8-9%, and they want to be at 2%. And so the market's been rallying. And it's like, what are you guys thinking? Because, we're really far away of where they want inflation to be, essentially. Keep going. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. So basically, we can't have prices keep going up like crazy or it'll kill our economy, essentially, right? And, let's keep going on here. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. So this is actually really quite interesting because here they're sort of addressing the point that in high inflationary times or high inflationary periods, the reality is the people who are in the lowest, income brackets really, really suffer, right? When the cost of food, energy, and rents and these kind of things, clothes, etc. When prices keep going up, skyrocketing, it just really affects people in the lower brackets. So, they're focused on trying to essentially help everyone is sort of what the case that they're making by keeping prices under control. The burdens of high inflation falls heaviest on those who are able least to bear them. Right? It's funny because I was already saying that before he even said it. So, but just for people who understand what's going on, right? So they're well aware that inflation hurts people at the bottom of the income scale. Just as you can see this here, restoring price stability will take some time. Okay, it's not going to be short then, and require using our tools forcefully. Oh, that doesn't sound good. To bring demand and supply into better balance. So if you guys understand this stuff, economy is it's real simple, right? It's all about supply and demand. If you have way more demand than supply, meaning that everybody wants to buy Nike shoes, but there's no Nikes to buy, price of Nikes go up, right? If you suddenly have a flood in the market with tons and tons of Nike shoes, and no one wants to buy them, then the price will come down, right? Supply and demand. So the idea, though, is that they're just out of whack. Prices are going up, demand is too high, essentially, and supply is low. And so the Fed can't really do much about supply if there's supply chain problems in China, but they can kill demand, essentially, because they can basically take money out of the system. If you have all this money in the system and people want to buy scarce goods, prices will go up. So they're talking about bringing the demand and supply forcefully, into better balance. Reducing inflation is likely to require a sustained period of below trend growth. So this is very hawkish language here. Essentially, if you want to reduce inflation, you got to slow the economy. And below trend growth is pretty strong language, right? That we're growing too fast and we want to reduce inflation is likely to require a sustained period. This means long, right? Of below trend growth. So not great for stocks, just so you guys know. Moreover, there will likely be some softening of labor market conditions. So we've talked about this several times before, guys. If you want to get inflation under control, unemployment's got to go up, and they're even saying it here, right? There will very likely be some softening of labor market conditions, so the people are going to get fired, essentially. It's interesting because they haven't really talked like this for a while. Or maybe it's the first time I should say this is really hawkish. I think that's why the market's behaving the way that it is. While interest rates, slower growth, and softer labor market conditions will bring down inflation, they also bring some pain to households and businesses. So, this language is very hawkish. interest rates are going up, the growth of the economy is going to slow, people are going to lose their jobs, but inflation will come down. That's what you got to do for inflation to come down. But it's gonna be a lot of pain for both regular people and businesses. Yeah. Um, these are unfortunate costs of reducing inflation, right? This is what you want to do if you want to get serious about inflation. You got to do these things. But a failure to restore price stability would mean far greater pain. And so in this regard, I agree with them. It's interesting to hear their languages. It's very, very strong and stuff we've been taught on this channel for a long time. If they're serious about inflation, they should have been saying this stuff all along, and they should have been doing it sooner. So, um, again, you need to, if you want to fight inflation, people got to lose their jobs. You got to raise interest rates. You got to slow the economy, right? All of these things. So it's generally bad for stocks. Um, the U.S. economy is clearly slowing from historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. While the latest economic data have been mixed, in my view, our economy continues to show strong underlying momentum. They always said every time that our economy is strong. I think if he ever came out and said, "Man, our economy is terrible. We're awful," they don't want to cause a panic, but they literally say our economy is strong every time he comes out. Um, the labor market is particularly strong, but it is clearly out of balance. Wow. Um, with demand for workers substantially exceeding supply of available workers. Interesting. So here we're talking about demand for workers. So what happens if demand for workers is high, meaning that companies like need workers, then essentially wages go up. And the issue is that if demand for workers is too high, wages go up too much, and wages are a really sticky part of inflation, meaning that it sticks. Like once you give someone raises, the salaries aren't going down, and then hence prices stay up because people again have more buying power, people have more demand, prices go up. So he's saying here demand for workers is exceeding the supply of workers. So we got to cool that off, cool the economy, cool business activity, and then people won't be needing workers, right? Um, this is all about fighting inflation. Inflation is running well above 2%, and high inflation has continued to spread throughout the economy. While the lower inflation reading for July are welcome, a single month's improvement falls short of what the committee will need to see before we're confident inflation is moving down. So basically, they're saying is, yeah, we saw that July we saw inflation come down a little bit, but don't get too excited. We don't know for sure if inflation is going to move down. Is essentially what he's saying. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. So this is pretty strong language. We're moving our policy stance purposely, right? They know what they're doing. They're trying to say to a level that will be sufficiently restrictive. Restrictive meaning like no more free money, guys. We need to get inflation down to 2%. And they've been saying 2% all along. But the thing is are they really serious about it? And now they're starting to sound more serious about bringing inflation down. At our most recent meeting in July, the FOMC raised the target range for the federal funds rate to 2.2 to 2.5%, which is a summary of economic projections range of estimates of where the federal funds rate is projected to settle in the longer run. In current circumstances, with inflation running above 2% and labor market extremely tight, estimates of a longer run neutral are not a place to stop or pause. Let me read this again. In certain circumstances, with inflation running above 2%, so we know inflation is high, and the labor market extremely tight, estimates of a longer run neutral are not a place to stop or pause. Okay, so they're going to keep raising interest rates. They're not stopping. We're not pausing. We're raising rates. July's increase in the target range was a second 75 basis point increase. As a mid-meeting said, I said then that this is unusually large increase could be appropriate at our next meeting. Okay, so he's signaling here that large increases in interest rates are still on the table. We are now about halfway through our intermeeting period. Our decision at December meeting will depend on the totality of incoming data and evolving outlook. At some point, as the stance of monetary policy tightens further, it will likely become appropriate to slow the pace of increases. So for those who are bulls, eventually they're going to slow the pace of increases, meaning that they're still going to be increasing interest, but they're not saying now. I mean, because going back up further, they're talking about pain. They're talking about slowing down, price. They want all about price stability. They're talking about slowing down the economy. So they all say eventually they'll slow the pace of the increases. I mean, they're still increasing, but at some point, I don't think this is necessarily going to be anytime soon. So we'll see here. Restoring price stability will likely require maintaining a restrictive policy stance for some time. Okay, yeah, he repeats it. So essentially, restrictive policy means no free money, and for some time. I mean, in this language, it is vague, and they can't tell you exactly, how long they're going to keep raising interest rates or how long it's going to be. Because essentially, here's the problem: is that whenever they do anything, it takes a while for the changes to affect the economy, the real economy. Like for example, this is a simple example. Just think of it this way: if I put a help wanted sign out my door, and I have a coffee shop, I put help wanted sign out. It takes maybe a couple weeks for someone to actually see the sign, and then for me to interview people and for me to hire people. The point being, whenever you change some sort of policy, it takes time for it to actually have an effect. So that's what I think the help wanted sign thing is a good example. So here, you know, um, restoring price stability will likely require maintaining a restrictive policy for some time. So they're going to keep raising rates, guys. Some people out there in the finance space have been saying that we're going to start a new bull market and stuff like that. It doesn't. I mean, it doesn't sound like that with what they're going to be doing for some time, right? Restrictive stance, no more free money. The historical record cautions strongly against prematurely loosening policy. Wow. So basically saying, according to history, is if you let up, if you go back to the free money too soon, it could be disastrous. Or it doesn't say disaster, but it's just saying, we're trying to learn from history here that we're not going to let off the brakes on the raising interest rates. Committee participants' most recent individual projections from the June SEP showed the median federal fund rate running slightly below 4% through the end of 2023. Oh, okay. So we're talking like all the way through next year. Participants will update their projections at the September meeting. Okay, interesting. This is very hawkish. So first we're talking about some time. Now we're talking about like through 2023. Our monetary policy deliberations and decisions build on what we have learned about inflation dynamics, both high volatile inflation in the 1970s and 1980s. Right, they're trying to learn from history here, and from low and stable inflation in the past quarter century. In particular, we are drawing from three important lessons. Oh, it's interesting. So basically, here, these people aren't stupid people. They know in the 70s and 80s you had crazy inflation. You also had high interest rates, right? And then they introduced monetary policy of low interest rates for quite a long time, and that's why you've had this really long, essentially bull market, because when money's free, and, the economy's growing, investment is up, etc. But when you start to tighten the amount of money that is in the system, everything changes. Let's just say what the lessons that they're talking about. So three important lessons. The first lesson is that central banks can and should take responsibility for delivering low and stable inflation. Okay, it may seem strange now that central bankers and others need to convince the other two fronts, but as former chairman Ben Bernanke has shown, both presidents has widely questioned during the Great Inflation period. Today, we regard these questions as settled. Our responsibility to deliver price stability is unconditional. So they're really serious. No conditions. We're going to do price stability no matter what. It is true that the current high inflation is a global phenomenon, right? This is not just USA, happening all around the world. And that many economies around the world face inflation as high or higher than is seen here in the United States, which is UK is really, really high. We've talked about that. It is also true that, in my view, that current high inflation in the United States is a product of strong demand and constrained supply, which we guys have already talked about that, right? There's too much money in the system. There's not enough goods to buy. Prices go up. And that the Fed's tools work principally on aggregate demand, right? So the Fed can't do anything about supply. All they can do is really affect demand. None of this diminishes the Federal Reserve's responsibility to carry out our assigned task as achieving price stability. This keeps saying over and over again. We're all about keeping inflation down, price stability. There is clearly a job to do in moderating demand. Jeez. Yeah, we got to cut demand, guys, to better align with supply. We are committed to doing that. We are committed to doing that job. Well, this is really hawkish. Like every sentence is like saying, "Yo, we're getting these prices under control. We're fighting inflation." They're sound pretty serious here, guys. The second lesson is that the public's expectations about future inflation can play an important role in setting the path of inflation over time. So this is a interesting issue is regarding like how people behave. If I think prices are going to go up, say next month, I'm stocking up on goods today, which is funny because what happens is that because I'm stocking up on goods today, anticipating prices to go up, I actually exacerbate inflation because I'm have a whole bunch of demand today, thinking that things are going to go up. So I'm just saying that's how things work. The other opposite is also true. Is if I think prices on something are going to go down, then I'm holding off on buying, and then no one's buying and think prices in fact do go down. So public expectations play a big role in how prices work. It's just kind of a funny thing that how people behave. Um, Today, by many measures, longer term inflation expectations appear to remain well anchored. That is broadly true of surveys of households, businesses, forecasts, and of market based measures as well. But that is not grounds for complacency, with inflation having well above our goal for some time. Yeah, so I mean, they want 2%, but it's well above 2% for too long, and you guys know this stuff. If the public expects inflation will remain low and stable over time, then absent major shocks, it likely will. This is the whole point of just telling you guys about inflation, how expectations play into it. Unfortunately, the same is true of expectations of high and volatile inflation. During the 1970s, as inflation climbed, the anticipation of high inflation became entrenched in the economic decision making of households and businesses. Right. Also, too, for example, it's hard to change sentiment of things as well in terms of like if you have a real negative outlook of the economy and you have negative outlook of like things in the future, or are you going to have a job and these kind of things, you're just less likely to spend money. The trick for the Fed is to and it's all about supply and demand, is to keep sentiment up, right? To keep people, that's why he always comes out and says that the economy is strong. He has to say that, whether or not it's true or not true. He has to say that because you got to keep sentiment up, and both in business and households, you want to encourage people to participate in the economy. They always talk about these kind of things. So let's see what else they have to say here, because basically, you can go positive spiral, you can go downward spiral. It's hard to change direction of the economy. That's kind of what's going on here. It's kind of, think of the economy like the aircraft carrier, and it's hard to turn these things on a dime. The more inflation rose, the more people came to expect it to be high. See, and they built that belief into wage and price decisions, right? So, if wage decisions would be like if the amount of hiring that you're gonna do, right? It's just interesting because he's really addressing this point of like you have the data and then also you have expectations which play into they feed off each other. Essentially, what's going on here. Um, as former chairman Paul Volcker put it at the height of the Great Inflation of 1979, inflation feeds in part on itself. So part of the job of returning more stable and more productive economy must be to break the grip of inflationary expectations. Okay, so kind of and this is kind of even more serious is, and I mentioned to you guys before is the Fed really unserious about fighting inflation or not? And it never really seemed like they were. And now they're trying to really change the language to say, hey guys, we're really quite serious about fighting inflation, and even if that means we have to raise interest rates and kill the economy for a year. This is sort of how I'm reading this stuff. And they're just coming out much stronger than we've had, and it's talk about on this channel how it's strange that the economy's not economy, sorry, the market's been rallying when I know that inflation is still high, and I know that they need to keep raising rates, but to be really frank, the Fed, their language hasn't really been this strong until today. So it's interesting to see this kind of stuff. Let's see what else they say here. One useful insight into how actual inflation may affect expectations about its future path is the concept of rational inattention. When inflation is persistently high, households and businesses must pay close attention and incorporate inflation into their economic decisions, right? So one of the things too, kind of like when inflation is high and prices are going through the roof, et cetera, that's all we talk about. That's all we talk about, and we can't not talk about it, right? Going here to when inflation is low and stable, they are freer to focus attention elsewhere. Yeah, so they're trying to get the focus off the prices, and everyone's just talking about it. So it's interesting because we're talking about both economic data, and he's also bringing in sort of our cultural milieu of the sentiment of the country and the economy. Former Chairman Alan Greenspan put it this way: for all practical purposes, price stability means that expected changes in the average price level are small enough and gradual enough that they do not materially enter business and household financial decisions. Interesting. So not only are they talking about getting inflation to 2%, they're trying to get it out of public discourse to where like people aren't talking about it anymore, so that it's not a problem. That this is really quite an interesting speech, guys. Okay, because normally they just say data dependent, data dependent, data dependent, but now they're kind of getting into data dependent and what is the real effect on real people who have to deal with it with inflation. And again, in the beginning of the speech, he talked about, and this is also true, is like people at the lower ends of the income spectrum suffer the most, and it just becomes the talk all the time of like how expensive everything is. I mean, it's just that's how regular people talk. So it's interesting that they're talking about, and also the same with businesses. Businesses will be talking about like, oh my God, I got to pay people so much money because people demand more money. When things cost more money, people want more salary to come to work, right? Essentially, what it is, and so just they're trying to get this out of the center of focus, inflation. Um, of course, inflation has just about everyone's attention right now. It's funny. It's like you can kind of see where his speech is going before he even says it, but we're on the right page with him. Of course, inflation has everyone's attention right now, which is highlights a particular risk today. The longer the current bout of high inflation continues, the greater chance that expectations of higher inflation will become entrenched. So once you get used to high inflation and higher prices, it just becomes a way of life, and you just get so used to it. So they're trying to break that culture and the data essentially. They got to raise interest rates. That's what's going on here. That brings me to my third lesson, which is we must keep at it until the job is done. Wow. Yeah. Okay. So rates are going up. They're going to stay restrictive, right? No more free money, and they're going to keep doing that until we get inflation to 2%. And remember, last read was 8%, so we're still 6% away from where they want to be. History shows that employment costs of bringing down inflation are likely to increase with delay as high inflation becomes entrenched in wage and price setting. Right? Remember, I told you guys this before. Um, the when prices go up, people want to get paid more, and then it just sort of exacerbates the problem. People get paid more, you got more demand, etc. So, the successful Volcker disinflation in the early 1980s followed multiple failed attempts to lower inflation over the previous 15 years. A lengthy period of very, very restrictive monetary policy was ultimately needed. Wow. This is the language. A lengthy period of very restrictive monetary policy was ultimately needed. Huh. I mean, it's just saying like this could be a long time. It's kind of what they're saying in terms of Volcker's case in the early 80s. Um, and it's funny too if you guys don't know because I know people are new to the markets and young. I'm pushing 50, so I remember a time when people thought like 7% interest rate on a home was good. Here in today's market, they think like 5% is high. So everything is really changed in the 1980s, and you had like in some years like double digit both inflation, double digit interest rates, like just wow. But so they're saying a lengthy period of very restrictive monetary policy. So this is a very 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 different language that they've been using before, and they're trying to signal that we're going to do whatever we can to get inflation down to 2%. They sound serious here. So a lengthy period of very restrictive monetary policy was ultimately needed to stem high inflation and start the process of getting inflation down to low and stable levels that were the norm until the spring of last year. Our aim is to avoid outcome by acting resolve now. These lessons are guiding us as we use our tools to bring inflation down. We are taking forceful and rapid steps. Oh, wow. Rapid steps. I wonder if they're going to be doing bigger, forceful and rapid. That means like front loading raise in interest rates is sort of how I read that. But, who knows? We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply and keep inflation expectations anchored. We will keep at it until we are confident the job is done. Wow. So they're not taking they're not taking a weak stance here. They're going hawkish. They're going to keep raising rates until the job is done. They want to break break demand essentially, right? And keep raising rates. And they want to get this out of public discourse, inflation. So that's my thoughts on this stuff. I just want to go through this whole thing with you guys. Love to hear your thoughts on this as well. And when you actually look at the language, and look at the primary document here, you can see for yourself that the Fed seems very serious about fighting inflation. And it's interesting because this is very, very different than other times when they seem a little bit more dovish. And I kept saying all along, I mean, we know they're raising rates. We just don't know by how much. And are they serious or not about fighting inflation? And I always said that because it just never felt like they were serious and just, like, hey, we're going to be really fighting inflation. But here they starting to sound really quite serious, actually. So they must see something in the data that that they don't think inflation is going to go away anytime soon. And I think the big problem, as I said several times, we're going through this, is you have when things cost more, people want to get paid more, and when people get paid more, it makes things cost more. So and you can't take back pay increases, once you give it to people. So that's a tough thing to fix. And as they're saying, there could be restrictive monetary policy. That's the phrase that they use for some time. So no free money. This, generally speaking, should be bad for stocks. I don't think necessarily. Who knows? I mean, I personally think the market is overvalued. And we'll see how the market responds. In this day and age, there could be a couple things could happen. Again, the war in Ukraine could end. That would help the markets. It would ease a lot of the problems in Europe. COVID could finally end in China as well. Would be more positive things. But generally speaking, if we're talking about slowing growth, raising rates, I'm cautious on stocks. I've been saying that for a while, and I can't tell you 100 what the world's gonna do, but I can say, if I'm interested in equities, I'm looking at bonds. I'm looking at keeping some cash, and if I'm going to get in stocks, I want to get reasonable PE ratios. I don't want to be in the crazy high growth things at valuations. How much you're valuing the company at unreasonable levels. So that's my thoughts on this stuff. Hopefully, this is helpful for you to go through this line by line and go through the language. So thanks again for watching, and I'll catch you in the next video.